Happy Friday. Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee. And joining me are my co-hosts, CoinDesk Managing Editor of Global Capital Markets, Lawrence Lewitton, and Managing Director of International Content, Emily Parker. Good morning, Emily. And Lawrence, a bit of a bloodbath this morning, unfortunately.
Yeah, this is a nightmare for a lot of people, but not unexpected. Yeah.
For a buying opportunity, let's take a look. Right now, the CoinDesk Bitcoin price XBX index is currently at $38,474, dipping below that $40,000 resistance support zone, down about over 9% over the past 24 hours. The CoinDesk Ether price ETX index at 2801 ETH, also retreating almost 12% for the day. The DFX CoinDesk DeFi index taking a step back, plunging 12.2% for the day at 353 points right now. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto news, events, and data. Lawrence, what's going on with the markets?
Thin markets. I mean, like this is, look, I'm not going to plug, but like, I kind of been warning about this in my newsletter for the past couple of weeks that, this has been pretty thin market. So when you had like a big sell-off in Asia, prices dipped this low.
There were some other experts, FundStrat, saying, more folks who had traditional legacy assets are probably, they're out of the market, getting out. And now it's for long-term buyers. Emily, what are your thoughts?
Yeah, I mean, the other interesting thing we're seeing here is just the sort of correlation with the larger equities market. This clearly isn't just Bitcoin, and also the correlation just kind of across the entire crypto market. It's Bitcoin, ETH, altcoins, so everything is kind of falling in tandem. So it sort of does, punch another hole in this myth of Bitcoin being this truly unique asset.
Yeah, well, who is accumulating?
Emily, so I've been digging through this data, Emily, and one thing interesting is if you look at the correlations with there is a relationship, but so far it's been pretty weak. I think one of the things you got to look at is also it's kind of a mix. It's like the equity markets, and also I would take a look at the value of the Chinese yuan. There are all these other aspects too. So it's kind of like some days it's going to be it's going to be the markets, but other days it's going to be Asia.
Yeah. Well, and some folks are accumulating, such as New York City Mayor Eric Adams. We have a clip. Let's have a listen.
In DC, promise made, promise kept. Took my first check in Bitcoin and Ethereum. This is a reason to highlight New York must be the center of innovation and new ideas. I want my young people to thrive in every industry.
Has a lot of folks talking. Emily, what are your thoughts?
It's so funny for like 100 different reasons. I mean, first, it's really funny that he made this video and then the market just like collapsed. Obviously, it's not a causation, but it's just kind of a funny correlation. It's also funny that he referred to a paycheck in Bitcoin or Ethereum, which are like the two most opposing terms. Like, I don't think you can, write a Bitcoin check. But anyway, it's a funny thing, but it's an interesting symbolic gesture as, he tries to take on the city of Miami as the center of cryptocurrency.
Yeah, it's hard to get mugged on the subway for Bitcoin. So there's that upside.
There's that. Eric Adams, we want you on the show. We've been asking. We're waiting. We've had Mayor Suarez. It's your turn. All right. Moving on. The Federal Reserve saying the current financial system might be bolstered by the creation of a central bank digital currency, but only one that works within the current network of private banks, rather than a CBDC that the Federal Reserve issues directly to consumers. The Fed releasing its long-awaited white paper on CBDCs Thursday. It did not commit to creating or not creating a digital dollar, but explained its questions and asked for public feedback. Joining us now to discuss is Minnesota U.S. Representative Tom Emmer. Welcome, Congressman, to the show. Anything surprising to you about this Fed report? What stuck out for you?
Well, I think it's a little premature to start going into it in depth, but I will tell you that I was pleased. It appears that we have agreement with the Fed that the Fed should not turn itself into a retail bank. So at least there's that. But I've got some other thoughts. They're just not ready for prime time yet. I've been through it a couple times.
Oh, we want to hear them. We want to hear them, Congressman.
We're not ready for prime time either, so you can do it here.
Well, I don't want to be caught between you and Emily, Lawrence. I mean, Emily's got this interesting outlook that's she'll go right after you, and you're looking for that positive spin every time riding the subways of New York. So,
exactly.
Look, it's an interesting report. I don't want to go into the details because we've been through it. I think the thing that stood out the most, because it's something that we were talking about last week when we dropped our bill on the CBDC issue, is that the Fed should never become a retail bank. I've got some concerns, but I want to go through the rest of the report in more detail and compare it against what we've seen elsewhere. This is going to need a lot of work. I'll leave it at that for now.
Congressman, you introduced a bill aimed at preventing the Federal Reserve from issuing a central bank digital currency directly to U.S. consumers. It seems that the Fed is not seeking to do that. So are your concerns somewhat abated somewhat? Does this mean that you'll be withdrawing that legislation or?
Absolutely not, Christine. No. Last Wednesday on the 12th of January, we introduced a bill that, yes, prohibits the Federal Reserve from issuing a central bank digital currency directly to individuals. We have some serious concerns, and I guess I'm not convinced yet that, simply put, the bill that we dropped is a statutory prohibition on a potential surveillance tool that I believe will kill private sector innovation and deflate the dollar's dominance. And my statement last week was Congress has to regulate our regulators. So your question, is there no need for this bill? Well, the bill was dropped because we have to have a discussion about what a CBDC model would look like. I've told you what my concern is, turning it into a surveillance tool. For instance, the idea that we would emulate the Communist Party of China. But that doesn't mean that there aren't some serious privacy concerns that we need to be concerned with, because if they're not going to be a retail bank, great. I agree. I'm good with that. But if you start to use the existing rails of our financial system, how are you different from a debit card, for instance? And by the way, if you're using those rails, what data do you believe you're going to be entitled to? I think we've got to, this is a very important debate because as far as I know, the only comment I'll give you this morning beyond that is it does not appear to me that they are offering a open, permissionless, and private option. It has to emulate cash. And right now, I've got concerns. But we'll give you more as we get the details. Through the details.
You know, something in the white paper, it said, very specifically, it spelled out the Federal Reserve Act does not authorize direct Federal Reserve accounts for individuals, and such accounts would represent a significant expansion of the Federal Reserve's role in the financial system and the economy. So it sounds like they're on the same plate. They're kind of, they're looking at it the same way you are, in that they don't have the ability to issue this to the general public. And they've also spelled out concerns about what it would mean to the banking system in terms of getting capital in if they have a competing product. So is there a way for you to work with the Fed or to at least, be on this? I know you guys aren't necessarily big fans of each other, perhaps, but is there a way in which you guys can say,
"You're not a fan of us, Lawrence"?
No, well, vice versa. In other words, I know you're not. You don't want total Fed control of the economy, and I'm sure that gets in the way of their ability to take over everything. But is there a way for you to work with the Fed to get to get a solid, clear line of what each one does?
It's the executive branch. We shouldn't limit it to the Fed. Remember, this bureaucracy was interested in collecting data, financial data on Americans' bank accounts with cumulative transactions of $600 or more. And frankly, they're doing it already on certain transactions involving Venmo, PayPal, I believe, and some other things. Lawrence, yes, we will always work with the executive branch, but there are some places that I don't think our federal government should ever go. Certainly, it's good to see that they acknowledge the law does not give the Federal Reserve that ability. But Lawrence, that doesn't mean they're not going to try and construct something that is not open, permissionless, and private, and then come to Congress and seek authorization, or if Congress continues to fail in its responsibility to exercise what is supposed to be the most powerful branch of government by ceding all of its authority to the executive branch, God forbid we start to get executive orders that are directed towards this sort of thing. So we're going to continue to work with them. It's one of the reasons we dropped the bill last week, because I didn't think the debate was a full debate. You know, all I was hearing in the ecosystem of Congress was, oh, my goodness, we're falling behind China. We need to catch up to China. We've got to have our own central bank digital currency, and we've got to do it very soon. It's like, no, the private sector is much better at doing this stuff than the government. And I think that's the other thing that's getting lost here. The race of the Fed, which hasn't exactly shown success in the last year or two with its monetary policy, Lawrence. So, I mean, keep in mind, because of the, I would say, flawed monetary policy both here and abroad, that's what gave rise to the cryptocurrency craze.
So your concerns are very well taken about privacy and the Fed having surveillance powers over, private money. But I guess the counter argument is that whether we like it or not, CBDCs are here, right? And it's not just China. I mean, China's obviously a first mover, but we have close to 90 countries actively exploring a central bank digital currency. So couldn't you make the argument that this is an opportunity for the United States to develop a central bank digital currency that protects privacy, that, it kind of like puts its mark on it? Because otherwise, you really will have, a trading system in which other governments are using digital currencies, and the U.S. just doesn't have one. So is there a way to sort of reframe this debate as not like we shouldn't do this, but like let's try to do this in a way that protects U.S. interests?
Emily, I'll go back to what I said to Lawrence. We should always have the discussion. But this idea that somehow our government's going to be the answer when it comes to a digital currency, I mean, really? You've got two ways of doing this. You've got the Chinese model, which to me is digital authoritarianism. The government controls all the information. It's centralized. It can be used for surveillance. It can be used to direct behavior, or you can use the existing financial rails that we have in this country as the way to move this around. But Emily, I'll ask you, why do I need the government to do that? I've already got debit cards that essentially are being used this way on those same rails. Why do I need the Federal Reserve? Why is it imperative that the Federal Reserve or the Treasury or whatever group within the executive branch, why is it imperative for them to drive this? This country is based on private innovation, entrepreneurial activity. What we should be doing is creating a light touch regulatory structure by defining once and for all, providing some clarity to what exactly is a currency, what exactly is a commodity, what exactly is a security, so that the entrepreneurs can have some certainty. We should create some safe harbors. We should create the so-called sandboxes to allow people to experiment and try things in the private sector in this country. That's how we will have the advantage over everyone else in the world. We don't need to emulate them. We can actually be the trailblazer in this country.
Congressman, what you're talking about sounds a lot.
The one quick response I would have to that is that, private companies in this country have not been particularly good about protecting individual citizens' data. I mean, just look at big tech, right? I mean, there has been rampant abuses of personal data, right? So I think this idea that private companies will protect data it's not necessarily the case. But anyway, that's a slightly separate issue. I guess, you said that you would support or you would be more supportive of a CBDC that is permissionless and has the privacy elements of cash. Do you believe that's technically feasible? Like, do you think such a CBDC could actually come to light?
It wouldn't be a CBDC. It wouldn't be a central bank. Look, Emily, where I would push back on you is decentralization is the whole point of blockchain technology. And we're moving, to your point, I'll just go back. Okay, great. Private companies haven't exactly been great. So we're going to give it to the government because it's been better. Well, both of us are in the same place. This is what I would say to you is everything up till now has required intermediaries. And this, as we go through this white paper, this report in more detail, appears to be more of that. What I think is going to happen in this country, if we allow the entrepreneurs to experiment and take risk and create, is you're going to move from Web 2 right now, which requires intermediaries like big tech. You're going to be able to move to what people foresee as Web 3, where we have our personal digital identities, where you and I are literally in control of our own information and can do our transactions without intermediaries. This both scares, I'm sure, the living daylights out of the central government people, while at the same time excites them, because that's what will help our country lead into the 21st century when it comes to this sort of technology. So again, decentralization is the point of blockchain. How do the government officials that are working on this suggest that we actually utilize that decentralization? This is no different than a Libra, or now it's called Meta, or whatever the Facebook guys are calling it, where they create their own universe and allow us in.
Well, Congressman, it sounds a lot like what you are advocating for. You said private entities creating digital currency. So that's being done right now. And we have Monero, which is a very privacy-focused cryptocurrency. We have Bitcoin out there, which is being used. Would you support just keeping what is in existence right now, such as those privately made coins?
Why should we stay static? I support all of it. I support people who have a vision of something that's even better. The problem with government is it gets in the way. We want to make sure that people are safe and people are allowed to experience freedom the way they visualize it. But our government trying to regulate with no concept of what it's regulating, or trying to take this great new frontier and stuff it into a box of the last 2 centuries of finance, doesn't necessarily work. And Christine, I guess I'm good with the existing financial system, which I think is the envy of the world, existing and evolving with this disruptive technology. But the problem is we can't stop the disruptive technology. So we got to find a way that the government doesn't screw this up. And I think there's a place for government, but for goodness sakes, every time it seems to jump in too fast, too hard, it actually frustrates this sort of thing. And I've got entrepreneurs that are starting projects outside of this country. That's what we want to avoid.
So why not just take it a step further and say, look, why don't we just ban CBDCs outright? Guys, this isn't going to work for us here. This isn't what the Fed should be doing, period. Even if it were allowed to, or even if you guys do it within your mandate, doesn't matter. It's not what you guys were created to do. Let the private system do it. Let stable coins exist, and buyer beware. Why not just go that extra step there and just ban it outright?
because I think this is worth the discussion, Lawrence. I mean, that's what I told you at the beginning when you were talking about would you rule out all these things? No. I think you have to keep an open mind. You have to have the conversation. Obviously, I've shared a perspective with you that is mine. And I'm going to tell all of you, certainly, if everybody would just agree with me, I think the world would be a better place, but that's not going to happen. Right? I mean, we have to have these discussions. We have to frame these debates. I'm going to learn a whole bunch of stuff by pushing back on this. And hopefully those that are on the other side of my perspective are going to learn from us, and together, hopefully we get to the place that we need to go, which is keep this entrepreneurial activity in this country, because I think it's the best place for this stuff to happen.
Congressman, the time flies by when we speak to you, but we got to wrap it there. Thank you so much for joining us this morning. That's the gentleman from Minnesota, U.S. House Representative Tom Emmer. Coming up, SEC Chair Gary Gensler wants greater regulation over crypto exchanges to protect consumers, but consumers need more protection. We'll discuss.
Hey there, it's Zach Stewart, co-host of The Hash and Deputy Global News Editor at CoinDesk. You're watching CoinDesk TV.
Checking in on Bitcoin, the CoinDesk Bitcoin price XVX index currently at $38,386. Bitcoin in retreat right now, almost 10% over the past 24 hours. And the CoinDesk Ether price ETX index is at 2790, also falling back about over 12%. The DFX CoinDesk DeFi index 352, plunging over 12% for the day.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
SEC Chair Gary Gensler wants greater scrutiny for crypto exchanges, asking his staff to look at every way to get these platforms inside the investor protection remit, according to a Bloomberg report. Joining us now is former SEC Commissioner Paul Atkins, currently CEO of Patomak Global Partners. Welcome, Paul. So, is there inherent danger to consumers from crypto exchanges? Are they not properly regulated?
Well, thanks, Christine, and it's a pleasure to see Emily and Lawrence also this morning. So thanks for having me. Obviously the chairman of the SEC is looking to expand the SEC's, focus on these exchanges. And I don't think there has been demonstrated problems, with respect to these exchanges to date. Obviously, we had a hack of Mt. Gox in Japan many years ago. Other than that, I haven't seen any allegations of problems. But I assume that the chairman is looking at this from a prophylactic measure. Let's try to prevent something before it happens. But the real question is, does the SEC have authority and jurisdiction over it? Do they have the tools and the means to be active as a regulator with respect to these exchanges or trading platforms?
Paul, good morning. Paul, good morning. How exactly would, if the SEC said, look, we wanted, it kind of made it clear that that's what they would like to do. But how exactly would they get that authority? They would need specifically Congress to act on it, correct? And how would they regulate? Would it just be centralized exchanges? Could they regulate DeFi? Could they regulate DEXs? Like, what's their limit as of now versus what they could do with Congress?
Well, I think, it depends. First of all, are they trading securities? I mean, one of the real essential questions that we have with respect to the whole crypto environment in the United States is the squishiness of the definition of what is a security. We have a, 60 or more 70-year-old Supreme Court test that looks at investment contracts, the Howey test that people refer to it as from the name of the case. But that itself it's all very, backward looking. It's very difficult for people to decide looking ahead as to what is or is not a security. There have been some of the large trading platforms have gone through elaborate internal mechanisms to try to figure out, is this a security or not? Can we trade it? Can it be, housed on our trading platform or not? So all of those questions, is as the SEC has been sending out lots of letters to various trading platforms, including on the DeFi side. I think people are trying to scratch their heads and figure out, what is it that the SEC would want? How would we actually register under the 1934 Act and be a securities exchange, if that be it? And especially, what if we don't have securities? Like even the SEC, at least to date, at least from statements from the staff and others, has said that Bitcoin is not a security, and I would agree with that. So that's one of the main types of assets that are exchanged on some of these platforms. So what is the, what are they to do with that? And so it's as if the New York Stock Exchange were being trading cash on the one hand, but then also, as it does, trade securities on the other on its platform. So I think there are a lot of questions that would have to be answered, and the way the SEC is doing this as regulation through enforcement or threatening to, I think, is a real problem.
Yeah, one of the issues that we're seeing now as to why Bitcoin ETFs that are dealing with the spot market aren't being approved is because Chairman Gensler seems to be very nervous about how spot crypto is traded on these exchanges, how spot Bitcoin rather. What is his fear? Is it manipulation? And if it is manipulation, who's doing the manipulating?
Yeah, well, I can't speak for him, so I haven't, talked to him about it or whatever. But if you look at what the staff has issued, both under former Chairman Jay Clayton and then now under the current chairman, they are concerned about the thinness of the market, the ability of big players to be able to manipulate the price, potentially, that a lot of this is traded offshore or whatever. I mean, they have a whole series of things that have been raised through their basically where they've refused to approve a particular product. So those sorts of things, have been indicated by the staff, but again, not by the commission itself, not necessarily by the current chairman or even the former chairman. So it leaves just lots of questions to be answered. And Hester Peirce, I think she's done a great job in identifying the problems there at the SEC and how the agency is ducking the essential questions. She's proposed basically a safe harbor for people to be able to try out their new ideas and then see how they develop. And as then they grow over time, then they either register or not, depending on what the attributes of the particular asset might be. So those are kind of the things that I think the SEC should be exploring rather than a regulation through enforcement approach.
Hi, Paul. Welcome. So you actually mentioned Commissioner Peirce's safe harbor, which, I agree it's a very innovative idea, but it does not seem to be gaining any traction within the SEC, which sort of highlights a larger problem, which is this regulation by enforcement, which you mentioned. So I'm just curious if you could sort of give us a bigger picture look, given that you're sort of at the center of this. How does the SEC under Chair Gensler compare to under Chair Clayton, for example? Has it really become much more enforcement focused, more, as other people have put it on the show, repressive? I mean, I'm just curious how you would look at this larger trend.
Well, we'll see. I mean, it's been Chairman Gensler's been in not quite a year in his position. So it took him a while, of course, to fill some of the spots. As far as the senior spots at the SEC. So I think we've yet to see what's going to go on. But I think all indications are they're going to be aggressive on the enforcement side. They could spread their forces too thinly, and if people push back in court, the SEC may find itself, like it has in the past, not being successful before an Article III judge who may not be impressed by their arguments. So we'll see. I mean, one case that actually started under Jay Clayton is his penultimate day in office is the lawsuit against Ripple regarding XRP and whether or not that is a security. We should get a ruling in that trial here sometime here in the next couple months, maybe. So that may be an indication of where things are going to go. And perhaps the SEC is waiting to see how it might fare in court on that. But a lot of these arguments, especially if they take aim at trading platforms, are going to get back to the essential question of what is a security and what's not. Because again, the SEC does not have jurisdiction over a trading platform if it's not trading a security. So, we come back to that essential question.
So just one question on that essential question. So as we know, the definition of security is quite murky. Is there any universe in which Ether could be considered a security in the current SEC? Because Chair Gensler has suggested in the past that he believes Ether to be a security.
Well, going back even before Chairman Gensler was nominated and then, of course, confirmed and appointed, there were some people who were saying, he's going to take a very hands-off approach to the crypto world because, he knows it and understands it and that sort of thing. I think that is not indicated by anything before or, currently. I think his, he had that lecture at MIT that people can pull up on YouTube or whatever, where he talks about how Ether is a security. But we heard back under, the previous administration, Bill Hinman gave a speech where he talked about how Ether has morphed from arguably being a security at the beginning with its, how it came about and the organization around it, to how it's morphed into that arguably it's not a security. So that actually gave a lot of people some comfort, although it was only a speech by a staff member and it's not a statement or action of the commission. But at least that was something. So I think I think it's arguable that Bitcoin and Ether are not securities, and there's an indication that the SEC may well take that particular point, but I think the ramifications of declaring Ether to be a security are huge, and I don't think the market really understands what that would mean with rescission rights of people who have had, who have traded Ether. If it's an unregistered security, that could just have a huge impact on, that whole ecosystem of everything that's then based on that particular framework. So I don't think the SEC is going to do that because of the ramifications of that. But right now it's still unclear.
All right, Paul. Thank you so much for your insights. Interesting conversation to have. Appreciate you coming on. That was former SEC Commissioner and CEO of Patomak Global Partners, Paul Atkins. Coming up, Crypto Markets Update with MarketGauge and checking in with CoinDesk Global Policy and Regulation Managing Editor, Nick Day. Hi,
Hi, I'm Christine Lee.
It's Zach Seward.
I'm Michael Casey.
I'm Christy Harkin.
I'm Isaiah Jackson.
I'm Serena Lynn.
Hey, this is Will Foxley.
I'm Teresa Santos.
Hi, I'm Lawrence Lewitton.
Hi, I'm Dorian Wayne.
I'm Nicola Day.
Hi, I'm Kevin Worth.
My name is Naomi Brockwell.
I'm Jordan Muthra.
Hi, I'm Galen Moore.
Hi, I'm Brad Count.
I'm Pete Paschal.
Hi, I'm Jen Sanasi. You're watching.
And you are watching.
And you're watching CoinDesk TV.
The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
All right, time to talk markets with Michele Schneider, managing partner at research and education firm Marketgauge in New Mexico. Hello there, Michele. Great to see you. All right, so the crypto markets are taking a nosedive. And, just a brief run through the headlines out there. They're blaming everything from a crypto ban, possible crypto ban in Russia, to market fundamentals, tech stock sell-off. What's your take?
Well, I think all of the above is a factor, obviously, and it had been hovering between 40 and 43, not really being able to kickstart. So the fact that it broke down under support levels following, and also far from the decoupling that people were hoping for following the rest of the market, is not terribly surprising. But like everything right now, people are extreme and people love to get either super bearish. I've seen calls for 19,000 in crypto, or hold on for dear life. If this thing is just going to still go up to 100,000. And the reality of the situation in the broader market and even in crypto is that it's very possible that we are just going to be testing a range-bound type market. We're still establishing what the low of the range is. I thought perhaps 40 would be the low. We're at 38. It's possible we can go to 28, which is where we were in October, and multiple times throughout 2021. Those lows really held, I should say 2021. And so I think that what's happening here now is that the market is really reflecting something that we kind of anticipated, which is sort of a stagnation, a wider range, choppy conditions, and that includes the cryptocurrency.
So, Michele, of course, you have people who are saying, okay, buy the dip, but is this actually the dip, or do we have further more to dip before you would say, okay, go in and buy?
Well, I have real trouble with trading by an aphorism, buy the dip, because there is more than buying the dip than just knowing that something has dropped. I mean, you want to take the classic example of how horrible buying a dip was. Just look at Cathie Wood's ARK fund. My God, what was the dip there? It's still dipping. So I think you have to really start looking for some other type of technical analysis other than these words, these three words that have become, a hashtag. What I would rather see is, again, if we're going to hold, let's say 38, which has been an area that it has held before, you have to not necessarily become the first person in. You really want to see some level of confirmation. And even if you decide that this is the greatest support level and we can't possibly drop another 10,000, which I think we can, then you have to get out. You have to be kind of nimble. And I think that's really what's going to be the interesting development this year, is what happens to these tremendous numbers of new retail investors who have not just entered the crypto market, but have also entered just the whole relative stock market. Are they going to learn a little bit more about risk reward? They're going to have to, or they're going to wind up being carted out, and that's going to be the end. I'm optimistic, actually, that when you have $25 trillion worth of new accounts that have opened over the last couple of years by retail investors, that just collaboratively and collectively, people will start communicating with, hey, you know what, if crypto breaks 38, we're probably going to go down to 28 or maybe even 30 or 31. And that will give some people an idea that, you can actively trade. We're not paying commissions anymore. So this could be the real general re-education. And these extremists, as I mentioned in the beginning, of, oh my God, we're crashing, or oh my God, we're going to new highs, will temper that to, this is really basically where the market has been historically for years and years and years. And only in the last several years have we seen these massive dips bought up because of a lot of, obviously, Fed policy as well.
Michele, what are you looking at the alt market? Because right now it looks like everything is kind of crashing together. Do you think that will persist, or do you think we'll finally start to see this decoupling that everyone has been talking about for the past year or so?
Well, if we do see a decoupling, I could tell you that will be like the Wild West all over again, and that would be a lot of fun. But I think if we step back and look at some of the developments that are happening in the crypto space in general, the whole idea of the Web3, the whole idea of the fact that we're going to be going from being controlled on the internet from a few companies to possibly decentralizing the whole space is super exciting, and that's where blockchain comes in. And then also I love the idea of the Uniswap and the Radium and the fact that at some point people, right now 12-year-olds are doing it, but at some point it might become easier, particularly people who have some sense of technical analysis, to be able to do these swaps on these coins, basically trade Ethereum for a different type of coin on that particular platform of Uniswap, for example. So I think the future is great in terms of all of that. But right now you still are in a situation where Bitcoin and Ethereum are the granddaddy and the grandmother, if we want to give them both genders here. And they're ruling even all of the altcoins. I mean, for example, Solana, which was holding up tremendously, obviously fell with the rest of the market today. But you get something like crypto.com, and that's sort of sitting here at around 40 cents. So you're going to have to judge things individually, but right now, I think the big thing is we're not decoupled. And what's really interesting to me is the big debate between gold and Bitcoin. Gold is actually doing well while crypto has been falling. So there's the new decoupling that we could be looking at.
Yeah, but if you zoom out, Bitcoin still has done much better over the past year. All right, Michele, thank you so much for the update. Appreciate your insights. That was MarketGauge Managing Partner Michele Schneider. Time now to check in with CoinDesk Gold Policy and Regulation Managing Editor Nick Day, who is also the editor of CoinDesk's The State of Crypto newsletter. Good morning, Nick. So, India's crypto industry has great expectations as they roll out a new budget. Tell us what's going on in India and crypto.
Good morning. So, yes, this morning, our colleague in India, Amitoj, reported that India's finance minister is set to unveil the upcoming budget, so detailing the priorities for the next fiscal year on February 1st. And while the industry doesn't know for sure if there will be, even a mention of crypto, they really hope that there will be, because that will indicate that the government plans to take crypto more seriously over the next 12 months. And really what they're hoping for is some hints as to how India might regulate crypto. There's, supposed to be a forthcoming bill for the parliament to look at, but we don't have details on that yet. And it's unclear whether India is going to, classify crypto as some kind of, an asset that investors can take a look at, or that would define how it will be taxed, or if there's just going to be a continuation of the limbo that the crypto industry is kind of, currently in.
So, Nick, on this side of the planet, you were watching Capitol Hill. Anything interesting happen on that front there?
I think so, honestly. So, this hearing, it started out, it was the Energy and Commerce Committee's subcommittee on oversight and investigation. So, not a group of lawmakers we've really heard from before. And the early questions kind of hinted at that. They were pretty basic. They were, about proof of work, blockchain, defining these terms that maybe us in the industry are familiar with, but that aren't as clear to folks who aren't, steeped in this 24/7. But by the end of the hearing, it had evolved into a pretty substantive discussion. There was a full-blown debate between Brian Brooks, the current Bitfury CEO, former acting controller, and Ari Jules, a Cornell Tech professor, about how exactly you define energy efficiency and how you define whether or not the crypto markets or crypto networks are becoming more energy efficient as time goes on. And, these kinds of debates are good, I think. They're kind of how lawmakers might perceive policy. And if there isn't a substantive discussion, then you're not going to get good policy.
Mm-hmm. Well, Nick, thanks for the update. Appreciate you coming on. That was CoinDesk Managing Editor of Gold Policy and Regulation, Nick Day. Have a great weekend, Nick. And don't forget to sign up for his newsletter, which he astutely pointed out. You have to go into one of his articles, sign up there. It's all on CoinDesk.com. All right, that's it for First Mover. Thank you, Emily. Thank you, Lawrence. You guys, too, have a great weekend. I'm your host, Christine Lee. Meantime, check out The Hash at noon Eastern and all that Bitcoin at 3 o'clock. You're watching CoinDesk TV. Asia crypto markets. That's now.
Welcome to the Daily Forecast, January 21st, 2022. I'm Megha Chadha of Forecast News, covering all things blockchain. South Korea's Science Ministry has announced a strategy envisioning the country as a global metaverse leader. We'll take a look at that story and a whole lot more coming right up. Let's get you up to speed from Asia to the world. Let's kick off with some of the top stories out of Asia today. First up, Russia's central bank has called for a ban on crypto and crypto-related activities. In a webcast, the bank's Director of Financial Stability described cryptocurrency as a pyramid scheme and that it is destabilizing because its growth is driven primarily by speculation. That could hit the mining sector hard as, according to a Cambridge University index, Russia is the world's third largest Bitcoin miner, responsible for 11% of the monthly hash rate share. It also comes amid wider moves across Asia to clamp down on crypto. Earlier this month, the State Bank of Pakistan recommended a ban on the use of crypto, while the Monetary Authority of Singapore issued guidelines restricting promotion of crypto services. And in the face of headwinds from Russia, Bitcoin reacted by dropping below the $40,000 mark for the second time in 2 weeks. According to CoinMarketCap, Bitcoin lost over 7.5% in 24 hours and was trading at just over $38,700 Friday midday Asia time, while the total crypto market cap has remained below $2 trillion since early January. Over in Taiwan, the chairman of computer hardware manufacturer Foxconn says 2022 is the first year of the metaverse for the company. According to Taiwan's Economic Daily News, Yong Liu said the company, which supplies iPhones for Apple, is to develop wearable devices, data centers, semiconductors, and content for the metaverse. Earlier this month, Foxconn subsidiary Enocon said it was set to receive almost $40 million worth of investment from Google, with the two planning to cooperate on metaverse projects in Taiwan. You can find those stories and lots more at Forecast.news. Sticking with Asian metaverse developments then, South Korea's Science Ministry says it envisions the country becoming a top 5 metaverse leader by 2026. Forecast News' Danny Park reports.
South Korea's Science Ministry has announced a 5-year strategy to lead the global metaverse market. Among the goals are to foster 220 metaverse companies that can earn revenues of over 5 billion Korean won, or about $4.2 million, to have 40,000 professionals in the field, and discover 50 examples of the metaverse being put to good use, such as by creating social value. The ministry's research also revealed some interesting details.
모기업이 운영하고 있는 메타버스에서는 벌써 150만 명 이상이 유의미한 경제적인 수익을 가져가고 있는 그런 것들을 알게 되었습니다. 그래서
Meanwhile, the government will support development of core technologies as well as protecting users from possible issues like sexual harassment or exploitation by setting guidelines for all companies to follow. Meta, which was formerly known as Facebook, recently said South Korea is best suited for the metaverse to thrive in, given the environment for hardware manufacturing and content creation. Seems like Korea could already be well on track to achieve its metaverse goals. For Forecast News, I'm Danny Park.
The arrival of virtual banking and internet-powered money transfer systems changed the face of banking dramatically over the last few decades. Who better to talk about that and all things disintermediation than Adrian Brink, co-founder of Anoma, a protocol that enables trading of any kind of digital assets among any number of parties with full zero-knowledge privacy. Great seeing you again, Adrian.
Great to be back.
Adrian, now the traditional financial systems operate and are regulated within defined geographical boundaries. Given this, can they truly be neutral?
So that you have to make a distinction, right? Within, for example, the banking system in Switzerland or the banking system in the US, and yes, they operate within their local geographies and local regulatory environment. And I think that's also the right approach. The problem becomes, how do you connect multiple sovereign systems? And so traditionally even right now, we use the SWIFT system for example, for banks to connect to banks in other jurisdictions. The problem is SWIFT was designed to be neutral because people realized in the 70s that it's a really important characteristic that you have a neutral base layer via which you can conduct international transactions. This has become under pressure, mostly due to the US government imposing sanctions and using the banking system to enforce them, though.
Now, what impact do you see on privacy preservation as we transition to digital currencies?
I think it's going to be really, really important to build privacy-preserving technology because privacy is a fundamental human right and is most likely a cornerstone of sort of a functioning governance structure and a functioning democracy. The problem is, as we're transitioning away from traditional financial systems more towards digital ones, we are losing a lot of privacy. This gets even worse when you're starting to talk about public blockchains and the privacy guarantees that those offer. But purely moving everything onto a Visa or MasterCard system just means that there is someone that can control and analyze hundreds of millions of data points every day, which was completely infeasible to do even 40 years ago. So it's a very drastic change that we're conducting right now by moving to digital financial systems, and we should be very careful about the privacy guarantees that we're building into them.
And lastly, a lot of people believe that their digital financial footprint is masked and safe by default. Is that correct?
No. The existing transparent digital footprint on, let's say, a blockchain is completely public. Yes, you may not be able to associate addresses with direct names, but once you have a couple of hundreds of thousands of data points, you start cross-referencing this to IP addresses that have actually submitted these transactions, and you get a very, very good picture of who these people are and what kind of transactions they're conducting. And the problem actually is, in the current realm, that anyone can do this kind of analysis. As in, anyone with an internet connection can start scraping this data and run a global financial surveillance program. In the past, this was reserved to a couple of nation states that can really conduct this. But specifically, the current technology that we're building in the public blockchain space is very, very vulnerable to this kind of big data analysis. And I think this is something that we're going to have to start fixing in 2022 and beyond in order to make these systems really usable for the general public.
Well, with greater decentralization comes greater data security risks. Adrian, thanks so much for the insight. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Megha Chadha. Until next time.